that the other permanents have, the investment. So it's missing the investment vehicle, which means it's missing a feature, which means less features, less money. And so there are needs that are permanent needs that we're going to talk about when we get to the whole life and universal ones. But I want you to keep in mind, if they say, but I need it at the lowest cost possible, that's when you include term to 100. And let me state it this way. If someone can't afford term to 100 and they need it even cheaper than term to 100, you give them convertible term insurance. Because it's term insurance that's cheaper now, they can convert to permanent later if they need to. So it's kind of regular permanent, most expensive. Term to 100, lowest cost permanent if they're good buying permanent. If they can't afford permanent, or they say I can't afford permanent, then you go to convertible term insurance because they can convert at a later date when they have more money to permanent. Everybody with me on that? All right, good. By the way, the easiest and hardest questions to get right in this course is the what's the best recommendation for the client questions. So that's why I'm kind of beating it into everybody's head today, because they're the easiest to get right if you see it, the hardest to get right if you don't. Okay. At what age can you purchase term to 100? I would say every insurance company has a little bit of a different number on that age gap, but I would say that's worth checking when you see them. But I'm not too sure offhand. Now you might be saying, Eric, we did 2 of the insurances out of 4 and we're only a half an hour in. Is it going to take an hour and a half to go through the rest? Oh yeah. But don't worry, don't be stressed. We're going to take complicated and make it simple, as always, but we're going to start diving into the little bit more complex insurances. Is everybody ready? All right, good. Need the sound? Which one? Just kidding. That one? Okay, no, it's okay. We're fine. We're keep going. For those of us that weren't here yesterday, yes, sometimes I throw sound effects in for fun. Sorry, they can be a little hokey. It's okay. All right, let's go. We're going to dive into a whole life first. I do it just have some fun because let's be honest. I wouldn't say this is the most riveting content all the time, but I try and be excited about it the entire way through. Whole life. Okay, roll back for just a second. One more time. I'm not going to roll back for everything, so we're going to have to stay on time. All right, let's go. Whole life has an insurance and an investment side, just like I've kind of mentioned already. Okay. Whole life is the rigid of the two main permanent ones, which kind of means unchanging. So once it is the way it is, it kind of just stays the way it is. Now, let's say this client had $130 is going into their plan. And let's say $40 went to the insurance, $90 went to the investment. So that means their $40 pays for the insurance amount, $90 goes into the investment account. Now, the first thing that's rigid about whole life is they actually won't give you a breakdown of 40 and 90. They'll just tell you 130. I'm just showing this as like an illustration of where the money could go. I'm going to say it one more time. Whole life does not give you the breakdown of where the money goes. I'm just showing it to you to help us understand the concept. Everybody okay? Okay. Some money goes towards the insurance, some money goes toward the investment. That's how these work. Okay. Universal does explain dollar for dollar. Whole life doesn't. I'm just illustrating. Then the next month, the same kind of thing happens 130, 40, 90, and it keeps going month after month after month. Okay. The first thing that's rigid in whole life is the price. If my client calls me and says, Eric, I'm doing better in life, can I put more money in? The answer is, that's awesome for you, but it's still $130 a month. We can't change the premium. And if a client calls me and says, Eric, I'm not doing as good, can I lower the premium? I'll say, I'm sorry to hear that, but it's still $130 a month. Rigid pricing. Okay. The second thing that's rigid about whole life is once you pick a type of whole life, you're stuck with that type of whole life. Once you start going down the path, they're like one-way streets. You just got to keep going. By the way, for those of us that are missing things at the end of today or in the break, I can roll back it for you, but we're keeping on time today as best as we can. And if you need me to go back to something at the end of today at 1 o'clock, my time when we're done, I can do that for you. Don't worry. Yeah. There are 2 types of whole life. There's a non-participating and a participating. They will also call them par whole life or non-par whole life, in short. I've seen them in the test with those ones, okay? I'm going to use a kind of a real life example to help us understand the difference between these two, okay? How many of us in the room have played team sports before? Okay, good. So let's say we're a basketball team. In basketball, some people are playing on the court, participating in the game. And then there's some people sitting on the bench, not participating in the game. Everybody kind of with me on this concept? All right. The participating and the non-participating, like being in the game, in whole life is investing the $90 per month. If you're non-participating, sitting on the bench, you are not investing the $90 per month at all. In the participating, you are investing the $90 per month. That's how it works. Don't get it complex. That means the non-participating does not grow at all, grows at 0%, sits in money like a piggy bank, does not grow interest. The participating, they do invest it. Non-participating does not grow, does not get invested, does not grow at all. Participating, we do allow the insurance company to invest our money. You're either in the game, letting them invest, or you're on the bench, not investing at all. Everybody kind of with me on so far? I knew someone was going to ask, so why in the heck would you buy non-participating? We'll get to that. But I'll tell you this, it has less features, so it's probably less money, right? That's a good way to think about it, for sure. Yeah. So non-participating, you would still be paying the entire $130, and money would still be put in the investment account. It's just not invested. It just sits in a piggy bank, like a sock drawer, whatever word you want to use. It does not grow. Participating, you let them invest it. Now, if I go one stage deeper, I'm going to focus on participating now. In the participating, we do let the insurance company invest the money, but we don't get to choose where they invest the money. They both have cash value, right? So participating, we can't choose where to invest the money, but we tell them yes. Now, they do invest sometimes in the markets, but sometimes they invest in things like a rental property. Let me give you an idea, okay? It will not get interest. Non-participating does not get interest. I'm not going to say it again. It does not grow at all. It's as simple as it is. Let's not overthink that, okay? The more we think about it, the more confused we get. It just doesn't grow. Money in your piggy bank does not get interest, right? This is like money in your piggy bank, no interest, okay? Participating, we invest the money. It can grow via interest, it can grow via things, but it pays out via dividends. Is there anyone in the room that does not know what dividends are? Because I will explain it, or wants me to explain it. Okay. I'll give you a kind of a example. So let's say an insurance company takes a bunch of money from their policyholders and buys an office building. They buy a building, and then they rent out people to work in it, okay? And at the end of the year, when they're charging rent and there's certain expenses in the business, if the rent is really high and the expenses are really low, they will create a profit because they'll make money. And what they'll do is if they profit, they'll give a kickback or a portion of those profits to the policyholders that invest in this rental building, okay? And they calculate them at the end of the year. In years where it doesn't grow, when the expense is really high and the profit's really low, they would not issue a kickback to the policyholders. What they'll do is they'll wait until those extra expenses are paid and there's another profit, and then they'll give a kickback then. So what I'm trying to say is whole life investments never go down, but they don't go up every year either. It goes up when the rental income in that example is more than the expenses. But if the expenses are high and the rental income is low, they will not issue a kickback to the policyholders, only on the years it profits. Everybody kind of with me in the example. If it profits that year, they give a kickback to the policyholders. If there's no profit that year, they do not give a kickback to the policyholders that year. That's a dividend, the kickback. So it's not interest growth like a percentage. It's money profited, and so it's a certain amount of money that it grows, that gets spit out, kicked back to you every year. I'm going to say this one more time to let everybody not ask ever again. The non-participating does not grow at all. And if you ask again, I'm not going to answer. I've said it 5 times already. We're going to keep going. We got to focus on more important things. Okay? I'm going to say this. Let's say this to everybody. I'm going to assume you are all capable and paying attention and at the level of actually paying attention in today. Okay? Is that okay? If I keep up with that expectation? Awesome. I'm okay repeating myself. But I'm not okay repeating myself 5 or 6 times over and everything, because we are going to have a bad time if we do that. So we got to keep going. If you need me to go through something at the end, we can do that for sure. Okay. Dividend. We do get options on how we want the dividend to pay us. The first option is called cash. This is called the dividend. So they say, well, Eric, your money went up by $100. So here's $100. And they send it to you in a check. Is it taxed? Yes, but dividends are taxed a little bit better than interest income. And if you need to know what they're taxed, search dividend in the text, and they'll tell you. The second option is accumulation. Accumulation is the idea that they reinvested. They reinvest the money. So they say, Eric, your money went up by $100. So we put $100 back in the investments. So they put it back in the investment pool. Nothing wrong with that one. The third one is called premium reduction. Where they say, Eric, your money went up by $100. So we're going to lower your premiums next year by $100. So I pay $120 instead of $130 next year. And keep in mind, these reevaluate every year. That doesn't mean every time I get a premium reduction, it keeps going down. The next year, if there's no growth, no premium reduction, it'll go back to 130. Okay. Second last one is 1 year term insurance. What they do with this is they say, well, Eric, your money went up by $100. So we purchased an extra $100,000 of term insurance, but it only lasts for 1 year, and then it goes away until the next year. So it's a lot of insurance that only lasts a short amount of time, 1 year. The last one, which I would say is the one that shows up the most out of all of them, so the one that everyone should probably pay the most attention to, and I'm going to explain it 3 separate times to make sure everybody gets it, is paid up additions. Paid up additions, or PUAs. Okay. All right. Here we go. Cash, they pay it to you in cash. That's a dividend. Accumulation, they reinvest your money. They put it back in the investment pot. Premium reduction, they reduce your premiums for that next year. 1 year term insurance, they buy a large amount of term insurance that only lasts for the 1 year that expires at the end of the year. Paid up additions is kind of the opposite to 1 year term insurance. They will buy extra, fully paid up, permanent insurance and add it on top of what you have. That's explanation 1. Explanation 2. They send you a letter in the mail and they say, Eric, your money went up by $100. So we add an extra $2,000 worth of permanent insurance on top of what you have. And keep in mind, your premium doesn't change. The $130 stays the same. We paid all of the premiums for that $2,000 extra from the dividend. So you don't have to pay anything extra. Explanation 3, real world example. My brother and I got together when my niece was born, about 30 days old, because he's in our business too. So we had a meeting. And I'm going to use hypothetical numbers. These aren't real numbers. But we put together a plan, let's say for $100,000 for her when she was 30 days old. And he picked the paid up additions dividend option. At the end of the first year, when she turned 1, let's say my brother got a letter in the mail. And it says, Mr. Harding, your money went up by $100. So we had an extra $2,000 worth of insurance on top of it. So now your policy that was worth $100 is now worth $102,000. But don't worry, your monthly premiums don't change. That $2,000 got fully paid from the dividend. And then the next year, he gets another letter in the mail and says, Mr. Harding, the money went up again. So we had an extra $3,000 worth of insurance on top of this. So now it's not worth $102, it's worth $105,000 now. But don't worry, your premiums don't change because that 130 is paying for the 100,000. The extra 3,000 we paid fully from your dividend. So essentially, if I say it in words, they are using the investment growth to grow the insurance amount over time. The investment growth fuels insurance growth. Paid up additions, the investment growth fuels permanent insurance growth. Shape it in an acronym. CATPP. Same as it's not going to be compounding, Irene, because it's whatever the investment growth was, they buy extra insurance. There's no compounding on each other. It's just a certain amount that grows every year. Now, keep in mind, this is only every year that the investment grows. If when my niece turns 3, my brother doesn't get a letter in the mail, that means the dividend didn't grow. So there'd be no cash, no accumulation, no premium reduction, no 1-year term, or no paid up additions. No growth, no dividend. Growth, dividend. Now, in whole life, we can change these. Changeable. I knew someone was going to ask. Got you, Carlos. You can change between them. Now, I'm not going to say how often can you change them. Well, I would say maybe once a year, since they only trigger once per year. But I don't know that for sure. Yeah, just like to answer Jason's question, whole life investment never goes down, but it doesn't profit every year because if it doesn't profit, no dividends. Yeah. Paid additions, you keep it for forever, right? 1-year term insurance, you keep it for 1 year. That's the difference. Yeah. You do choose them at the start, Ramon, and then you can change them during the policy. Yes, for sure. Everybody all right? Yes, the paid up additions is a permanent increase. The term insurance is a temporary increase. That's the difference between the two. Okay. All right, awesome. The dividend, everyone needs to understand the dividend growth gets used for these things. You pick how the dividend gets paid to you, and you don't think you can mix. Yeah. Perfect. Okay. To answer Alan's question, you don't get to choose where the investments are in whole life. Like I mentioned before, that's going to be in universal life. We do not get to choose in whole life. The insurance company picks for us. Dividend is only participating, Grayson. Non-participating does not grow. Okay, I'm going to write this up here just so everybody can stay with me. Does not grow. I'm going to say this. I'm not going to say it again. Okay, why don't you put that in your notes? Okay. All right, here we go. Let's go. Let's talk about a feature that's in the whole life. And it's called automatic premium loan. Or APM. I just read that it does grow from interest only. So interest only is universal life, Vanessa. Whole life is interest and these dividends where they invest in things, but it gets issued as dividends. Yeah. Automatic premium loan is the reason you would buy non-participating over term to 100. So everyone that's wondering that question, stop asking questions and start listening. Okay? Automatic premium loan is what happens when you miss a payment in a whole life plan. If you miss a payment in a term to 100, you need to make up that payment in 30 days. They call it a grace period. If you miss a payment in term or term to 100, you have to make up your payments. Otherwise, your policy goes, If you miss a payment in whole life, there's an investment there that they can draw on to pay your premiums if you can't pay them. What it does is it creates a loan in the background. against your cash surrender value, the amount of money in your investment. So why would someone have a non-participating over a term to 100? If you miss a payment in term to 100, policy goes bye-bye. If you miss more than 1 month worth of payments, because you have 30 days to make it up. In whole life, if you miss a payment due to insufficient funds or you change your banking and tell them, an automatic premium loan alone will catch you like a safety net, so your policy just doesn't vaporize. So why would someone buy non-participating over term to 100? So if they miss a couple premiums, their insurance doesn't go bye-bye. Now you might say, well, Eric, since it's a loan, is there interest on that loan? Yeah, for sure. What is the percentage of interest? Depends on the company. So I've seen anywhere between 2 and 12. So there's lots. But I'll keep in mind, APL, automatic premium loan, is only a feature of whole life, participating and non-participating. The participating part only determined the growth. We're not in the growth anymore. That was the dividend stuff. We're done with the dividend stuff. It's a great feature. It catches you in case you miss some payments, in case you run into rough times. It's a safety net. Now keep in mind, this is not for someone to pay for a little while and then never pay again, right? This is if you miss a payment you were supposed to make. And yes, you can pay the loan down later if you want. I will explain more about loans later, so don't have the floodgates of all the loan questions. We're going to get into loans later, don't you worry. Okay? I just want you to know that it doesn't go away. It creates a loan in the background. Okay? The automatic premium loan will last as long as the money you have in the account. If your loan starts catching up with your cash surrender value, guess what? You got to put in more money, pay down the loan, or your policy's going away. Your cash surrender value, it's the amount of money in your investment account inside of your insurance. And yes, non-par and participating both account for automatic premium loan. Yeah, only for whole life. You got it, Adrian. All right, let's talk about the 3 ways you can pay for a whole life. There's 3 ways you can pay for a whole life policy. The one you probably are thinking of is ongoing, where you pay until you pass. That's the way I remember it. You keep paying every month, every year, forever. Kind of is a good way to think about it. There's something called limited pay, where you pay for years and then stop. I'm going to put a little thing here. It's paid up now. So the plan that my niece has, it's a 20-year limited pay plan. So my brother pays more for the first 20 years to pay nothing after 20 years. So it is more to do limited pay in a premium per month, but then you don't pay after the 20 years. Whereas ongoing's less monthly, but for a longer period of time. And then the last one is single payment, where you pay once. That's it. We're still talking about whole life, everybody. We're still talking about whole life. I'll tell you when we switch gears. Don't worry, you'll know. Single pay or lump sum? Sure. You pay once all of your premiums single, and then you don't pay ever again. So you can pay all your premiums at once, single pay your premiums in a shorter period of time, limited pay, or pay them forever. Ongoing. And the shorter the time frame, the probably more expensive it is for that payment, but potentially less for later. Limited pay is you pay 20 years and it will stay in force forever. Single pay is you pay once and it will stay in force forever. Ongoing, you keep paying so it stays in force forever. Single pay is the most expensive at the start, Rajesh or Raj, but it is less over the long haul, probably. Yeah. Everybody okay? All right, these are the 3 options. Can we convert between the 3? I don't think so, but don't quote me on that. Yeah. I don't think you can change in between. Remember, whole life, rigid. Premiums, the way the premiums are once you choose them at the start. Yeah, ongoing's paying monthly or yearly, Yan, but you're paying forever. You're not paying a little bit and then not paying later. Yeah. And you're the one that picks. You, the client, and you as the agent. You got it. Let's talk about some riders, some add-ons you can put onto whole life plans. Okay? We're going to talk about 3. Now, are these the only 3? No, but we're going to talk about the main 3, as always. Okay? Here we go. We are going to talk about waiver of premium. Somnath, yeah, you can. You can cancel an insurance policy anytime you want, really. Yeah. But there's consequences to it, for sure. The first one's waiver premium. Waiver premium is a rider you add on. Now remember, you add riders on the start. You've been paying for them every month. They cost a little bit more money, right? This rider says if you get disabled during the life of your policy, you stop paying while disabled. So if you go back to work, you would have to start paying again. If you never go back to work, you never have to start paying again. Now, don't let them catch you with the, oh, it only pays for the insurance bit. Oh, it only pays for the investment bit. Oh, it doesn't pay for the riders. Yes, it does. It pays for all of it every time. So it pays the entire 130, insurance and investment, and the riders. Say it one more time so we don't get asked again. It pays all of the premiums plus the riders every time. No half measures. If you go back to work, you got to start paying again. If you never go back to work, you never have to start paying again. The second one is called a parent waiver. It's not a premium pause. This is a they pay it as if you pay it. So they will pay the $130 a month as if you're paying it into the insurance and investment. It's not a pause. It's a they pay it for you conversation. The second one is a parent payer waiver, which sounds very similar to waiver of premium. Because if you get disabled, you stop paying premiums while disabled. But there's one distinct difference between the two. But I'll put all of it here too, because this is true too. The difference between waiver premium and parent payer waiver is waiver premium is me paying for me. So I'm paying for my own policy, or maybe I'll put it in a different way. The insured and payer are the same. So the person whose insurance is on is the person who's paying. I don't know how long the form would be, Reza, on that conversation. You would have to reach out to each insurance company to know that. I don't know their claims processes in that way. If the insured and payer are the same person, so it's me buying policy on me and I pay for it. If I get disabled, I don't have to pay for mine. Everybody with me on that? Okay. This is when the insured and payer are different. Like my brother paying for his child. So my brother pays for my niece's policy. So it doesn't matter if my niece gets disabled to pay the premiums. It matters if my brother gets disabled because he's the one that pays the premiums. He's the payer or the parent to that plan. So you would put a parent payer waiver on that policy. So it's not about if my niece gets disabled. It matters if my brother gets disabled because he's the one paying for the policy. Everyone see the difference? Waiver premium is me on me. Payer is I pay for someone else. And in the payer parent waiver, it would be worthwhile for you to remind yourself both people have to go through underwriting because they need to check the life insured to make sure they're healthy, and they have to check the parent or the payer to make sure they're healthy, that they're not currently disabled right now. So they both have to go through medicals. Whereas in the waiver, it's the same person going through medicals, both sides. That's the difference between the two. Okay? Because they will ask you, where they put a parent waiver, and then they'll say, the parent doesn't have to go through medicals because the policy is not about their life. Yeah, they do, because if they get disabled, insurance company pays. Everybody okay with the difference between the two? Okay. Just the payer has to get disabled on the payer waiver. Just the payer. Yeah. One comment about waiver premium I'll throw in there. You can get a waiver premium on term insurance as well. And a cool tip about payer waiver, which I've seen the question show up, is if it's a convertible term insurance and someone gets permanently disabled, it will convert to permanent and they will still pay it for life. Pretty cool feature. And that might be an interesting exception question that they could ask you. Yeah, but remember, every time you add a rider, you add a cost. Let's keep that stuff in mind. If you get waiver premium on a term policy that's convertible, if you got permanently disabled, you can convert the term to permanent insurance and the insurance company will still pay it for life. In the payer waiver, they do not both need to get disabled. Just the person paying has to get disabled for it to pay. Yeah, it's about the person who pays, not the person who's insured in the waivers. Yeah. The last one is guaranteed insurability benefit. They both have to go through medical checks, right? One for the life insurance on their life, the other one for the disability benefit of the waiver on their life. You got it. Some good questions coming right now because everyone's listening. It's awesome. Within how many days after permanent disability? That's a good question. I would say that there might be a waiting period, but I don't know that for sure. I would say there probably is. But it doesn't have to be permanent disability. It can be limited disability. They will just pay it for a limited amount of time. If it's permanent disability, then I think anytime after that. But there needs to be stuff backed up by doctors, attending physician statements. Right? We can't just say we're permanently disabled and get our benefit. Yeah. Guaranteed insurability benefit. Does everyone remember yesterday, or if you were here, that we talked about that future purchase option, buying more disability in the future without proving your health? This is exactly the same thing in life insurance. So you can purchase more insurance, no medicals. Permanent insurance, no medicals. Does it have a limit? Probably. Every company probably has a limit, but I don't think I've seen one in the text. Guaranteed insurability benefit is the concept that later in life, someone can add more permanent insurance without having to prove their health a second time. So my niece also has this on her plan. And so let's say at age 15, we decide to increase her coverage by 100,000. Well, then they're not going to ask any medical questions, but the one thing that they are going to do is at the age of the increase, let's say 15 years old, that 100,000 you're buying, you will pay 15-year-old prices, not 30-day-year-old prices. Let me say it one more time. You pay for the increase at the age you do the increase. So if I do another increase at age 20, that increase at 20 will be 20-year-old prices. And you don't have to pay lump sum. They might just bump up your monthly. But if you get more coverage, you be sure that you're going to pay more money for it. And if you're a single payment, it would be a lump sum. If it's a limited, you'll pay for a limited. And if it's an ongoing, you'll pay forever. Like it's the same payment schedule. Yeah. Everybody okay with these three? This is only for whole life, everybody. Only for whole life right now. You have to show financials for that. No, you don't. There's no financial qualifying here because it's not attached to an income like disability is. A good question. You pay the premiums at the age you do your increase. So my niece got it at 30 days old. If she does the increase at 15 years, she'll pay 15-year-old prices just for the increase. And then if she does another increase at 20, she'll pay 20 years for that increase. So she could have a 30-day-old price, a 15-year-old price section, and a 20-year-old price section. They all are when you do the increase. You pay that price. We're not at UL yet. We're still in whole life, everybody. We'll get there. Everybody okay? Awesome. All right, let's talk about some keywords now for whole life. And then we'll get into the universal life. I feel everyone's chomping at the bit to get into universal life already. It's okay. I appreciate your enthusiasm. Well, we're getting there. The keywords for whole life is funeral expenses, or final expenses, you could say. Taxes at death is the second one. So they want to cover selling of their real estate, selling of land, some kind of taxes that they want to cover, and charity donations. We're going to talk about later, Nona, what happens when you withdraw money out of a permanent insurance later. Don't worry, we'll get there. Yep. How about a disability child? What about a disability child? If they can qualify for life insurance, maybe, but if they can't qualify for life insurance, you can't do that, right? It's about whether they can qualify medically for it. Yeah. Leaving an estate and taxes at death is kind of the same thing. And final expenses, right? But you could do leaving an estate. I'll throw that in. Sure. Don't mind. It's accurate. Just got to answer a text here. Hold on. Got a text saying someone's going to work outside on some yard work right outside this window. So hopefully you guys don't hear it, but if you do, it's okay. We're just talking whole life right now. We're just talking whole life right now. We're just talking whole life right now. We're moving forward. Okay. Is there another insurance to do for final expenses if you don't qualify for whole life? That's a question to talk to your field trainer about. If you don't qualify for one and you're declined, you should go and talk to your field trainer to see what you can qualify for. Because if we're talking hypothetically, right, if you get declined, you get declined. Most of the time, depending on what it is from everywhere. But that's hypothetical, not real life. There are policies out there that will cover anybody, but that's not time for us to dive into that right now. Leave an estate. You got it, Christine. Yeah. All right. Leave an estate. The word estate, for anyone who doesn't know what this means, is leaving money to your family. When you pass. Okay. For anyone who maybe doesn't know what the word estate means, just to clear this up, because you might be like me and didn't know anything about the insurance world when I came here. Your estate is your legal entity when you're no longer living, your financial entity. Has anyone seen like a really big house with like a huge yard and all that stuff, and they called it an estate rather than a house? That's basically conceptually what yours is. It's got your house, it's got your money, it's got your debts, it's got your savings, it's everything. It's just called your estate. And you can name an insurance policy to go to your estate, aka to that pool of money, to cover your debts, to cover taxes, to cover all that stuff. And then the estate gets split via your family when you pass away. Anything you own, Rosalie, technically will go into the estate. So yes. You're right. Estate is not guaranteed to go to your family, but we're just talking conceptuals. We're not talking every times. Yeah. I was thinking property estate, but maybe there's more to it than that. Yeah, estate's just like the entity of you when you're no longer there. So when someone comes in, and starts taking care of your finances when you're passed, they're dealing with your estate, is what they call it. Everything. Dollars, investments, debts, everything. So if you want to leave some positive, that's what permanent would be. Yeah. All right. Let's go. Let's get into it. Let's get in this universal life conversation. Or you will. Now, fair warning. I'm going to warn everybody right now. In about 5-ish minutes, I'm going to stop questions for about 15 minutes. Not because I don't like questions. I love questions. But I know some of you are going to focus on asking me questions rather than paying attention to what I'm saying. And we're going to stop that. Okay? For a limited amount of time. Because I need you to listen so I can make it confusing before I can make it clear. And if you're not paying attention, I'm going to lose you. right away. Okay? We're not there yet, but we're almost there. Okay? For those of you that want to stop the chat, you can stop the chat on your side too. It's possible. Don't worry, but I get it. It can be a little distracting sometimes. Universal life has an insurance and an investment side, just like whole life. Universal life is the flexible version of the permanent ones. Universal life came to be, in my opinion, because whole life wasn't. So let's say this $130, 40, 90. Let's keep those same numbers. The first thing that's flexible in universal life is this premium. They can change this. So if the client calls me and says, Eric, I want to put in $230 a month, I'm going to say, great, let's do it. The insurance cost doesn't change because that's the amount of the insurance. It's not a percentage, but they'll invest $190 then. The amount invested changes. And let's say if they want to lower it down to $70, let's say, that means 40 would be the same. $30 gets invested. So there's flexibility up and down. If a client wants to put in a little bit more money or a little bit less money, they can. Okay? That's one of the main things about universal life. I'm going to put the keywords over here. Okay? Flexible premiums. That's one of the keywords. You're right. I'm not changing the insurance amount because the insurance amount stays the same because you're not changing the amount of coverage when you change the premiums. Yeah. What if someone wants to put 30? They won't be able to because 40 is probably the minimum cost you can, and some insurance companies put a buffer on this. So it might be $50 is the minimum at that insurance company. You can't go any lower than 50. Okay? The second thing about universal life is it is more investment focused. And I'm going to explain that in a second. The last one is it's higher risk than whole life is. So let me compare the two. Okay? I'm going to scroll up in a second and I'll come back. Okay? I just have a question for the room. Okay? When we were talking about whole life, there's an insurance and investment side to whole life too. When I was talking about my niece's policy this entire time, was I talking about growing the investment bigger and bigger and bigger? Or was I talking about growing the insurance amount bigger and bigger and bigger? You tell me. Let me know in the chat. Was I talking about more and more insurance, or was I talking about more and more investment? And you can't say both. Right, more insurance. So which one is more important here? The insurance. Because the investment never goes down. So what I want you to think if I tell you nothing else to figure out between whole life and universal life, listen to me right now. Whole life is more about insurance over your life. In universal life is more about investment growth over your life. That's the difference. If nothing else works and nothing else makes sense of figuring out between the two, is the client more about the insurance staying there for life or more about the investment being there for life? I make a joke here sometimes about the fact that I could no longer have blankets on my bed. I had to start having duvets on my bed when I got in a relationship. I don't really understand the thing about duvets. It's just a blanket inside of another blanket. Why not just have two blankets, right? But as you can tell, I didn't win that conversation, right? And when you got to open up a duvet and tie the little thing on the inside, and then you got to like tie the other one on the inside, and it's okay. Eric's fine. But the fun part is, I know everyone's going to chime in. It's to keep it clean, so you don't have to wash. Just wash both blankets. But anyway, I don't need to get fired up about that. It's a priority difference, right? Priority difference. So the difference between universal life and whole life is a priority difference. Insurance over your life, investment through your life. Everyone with me? Okay, good. The reason why universal life is a little bit higher risk is because you do get to choose where you put the investments. And it does go up in interest, but it also goes down as well. So universal life can go up, but it can also go down. Whereas whole life never goes down, but it only profits sometimes. Everybody understand what I'm saying? It follows the market, and we get to choose as the agent and as the client where we put it. And yes, you can change it. Okay? That's the difference. So if a client talks about needing flexible premiums, if they talk about investments more than insurance, and if they talk about they're okay with some extra risk in their insurance, they want universal life. Which one would cost more between whole life and universal? Well, universal is more flexible. It could be cheaper and it could be more expensive because it's more flexible. The other one's just static, right? It depends. All right, let's go. Can riders be added on to universal life? Yeah. So let's go. Let's talk about the first option you have in universal life, and that's the insurance cost column. So that $40 a month, we got some options on what we want to do with that $40 per month column. We have level, cost of insurance, or LCOI. And which stays the same. Then we have yearly renewable term. So level cost of insurance, the $40 stays $40 the entire way through the plan. Yearly renewable term, or they will also call it annual renewable term. They mean the same thing. They are the same thing. They will say both. ART. This is every year the price yearly renews. So it'll be cheaper when we're younger, not so cheap when we're not. The price changes every year. So it might be $40 a month this year, the insurance column, but it might be $42 next year, and then $43, and then $45, $47. Every year it changes. Now someone's going to be like, but Eric, which one's better? There's no which one's better. There's which one fits the client. And don't ask me which one's better for you, because I'm going to refer to your field trainer every single time. Now, what I'm going to do is I'm going to graph these together, and I'm going to compare them. And this is where questions are going to stop. And I'm going to say this clearly. Even if you ask questions, I'm not going to answer them for the next 15 minutes. Everybody okay? Everybody ready for me to roll past this? Let's roll past it. Okay. Give it a second, and then I'm going to compare them in a graph together. Perfect. Let's go. Graph them together. If the time is the bottom is time or someone's age, and the left side is insurance cost column in dollars. Let's say you pick a level insurance and it costs $100 a month for the insurance cost, but it stays the same for the rest of your life. Then let's see you got a yearly renewal term plan and it was $18 a month at the start, and then it goes like this over time. It grows every single year. Some of you might say, well, Eric, that's a lot of money that I'm going to pay later, and I don't really want to do that. And I would kind of agree with you in a way. But then there's a group of you that might say, but I'm saving a lot of money in the early years. Because if we're putting in the same amount of money, the YRT person's putting much more in the investment than the level person. Because if we're all putting in that $130, the level person's only putting in $30 a month in their investment, whereas the YRT person's putting in over $100, at least at the start. And then the insurance goes up and up and up. So there's no which one's better. It's which one matches the client better. And here's I'm going to show you one example where yearly renewable term can be good, but please hear me when I say this. If your field trainer or SMD does something different than what I'm about to explain to you, do what they tell you to do. I'm talking in hypotheticals. They're going to talk about a real client. You do what they tell you to do. Okay? If I get a call from your field trainer or SMD that says, Eric, they want that plan that you showed them in the class, I'm going to show you them this 5-minute clip of me telling you to do what they tell you to do. I'm only going to do it twice. And let me look at you seriously. Do what they tell you to do. Okay, let's go. It's kind of a joke, but I mean it. I don't want to get those emails. Here we go. We're going to talk at this intersection line. And we're going to talk about the yearly renewable term person for now. Let's say this yearly renewable term person has grown $25,000 in their investment. So out of their monthly contributions, they have grown $25,000 in their investment vehicle, their cash surrender value. And we do get to choose where the investment goes. So let's say this person earned 5%, because it does show in percentages now, up and down. That means the person grew it by $1,250 that year, or just over $100 per month. So Eric, are you saying that because the insurance cost is $100 and the investment cost grew by $100, it kind of just paid for itself? Yeah. So they could put like no money in this year. Yes, kind of, but I would never tell a client to not put money in. Why? Because not every year is 5%. But if that's growth in their investment, because in whole life, right, you got to pick the dividend option. In universal life, it just grows the investment in the background. Okay. So just my opinion, I usually recommend my clients still put funds in anyway, because not every year it grows. Some years it goes down, just like the market. Is everybody with me so far? Okay. Now, some of you might be saying, well, this was my plan. When I first got a plan, I paid $18 a month for it for a certain amount of insurance, and I put $130 in from my liquor store manager's salary of $12.50. Now, you might not be 19 like I was. You might be like here in your graph. And you might say, well, which one's better now? Well, level, you might say. Well, it depends. Right? If it's $75 a month for the insurance cost, but you're making more than I was, making $12 an hour, and you put in $300 a month, well, you're still putting in over $200 in the investment. So it's not about there's enough money in there to make it about the investment like it's supposed to. So it's not about which line you pick. If you like the level line, hey, you're a level client, and you can have level clients. There's nothing wrong with that. But if a client's looking to invest more money in the shorter part of the term at the beginning of the plan, they are yearly renewable term people. So I'll tell you what I'm saying. If they talk about short-term putting money in investments, yearly renewable term's better because it'll never be cheaper than at the start to put money in. And if they're talking about long-term stuff, then maybe it's a level person. That's okay. There's nothing wrong with that. Short-term investing, yearly renewable term. Level, long-term. That's the way they treat it in the text. That's the way we got to learn it for the test. Clear? All right. Good. I'm going to keep going. And no, questions are not open yet. I'll let you know. Okay. Everyone got the graph? Okay. Can I move past the graph? I'm taking a pause. I see 2 more people writing on my screen here. I'll just scan through a couple other people. All right. Let's go. We got other options about the insurance amount. Now, I'm not talking 100,000, 250,000, 500,000. While those are all options, that's not what we're going to talk about. We're going to talk about how much goes to your family when you pass. Okay? We're going to talk about 2 at the beginning, and then we're going to add 2 on at the end. There's death benefit, or maybe we could call this face value. I'll call it death benefit for now. And death benefit plus account value. And I'm explaining with these little squares. Just the best way to explain it. Okay? Let's say we invest or we buy a $100,000 policy in each one of these. Okay? In the death benefit option, my family will receive the death benefit, the $100,000 when I pass away. That one's kind of easy to grasp right away. Okay? In the death benefit plus account value, my family is going to receive my death benefit plus my account value, which means it's plus the cash value, cash surrender value, the account value, whatever word you want to use, they add the investment on top. So they'll put the 20, let's just keep the numbers the same, 25,000 on top. So my family will receive the 100,000 plus the 25,000. So they'll receive 125,000 when I pass away. Now, the keen-eyed in the room might have a question in their mind. Well, in the top example, where did my 25,000 go? Is it just gone? Well, it's not gone. It actually makes up the first portion of the 100,000. So, Eric, you're saying of the 100,000 my family gets, 25,000 of it's mine? Right. And this is where you might feel confused. And if you do, perfect. You're in the exact place you should be. So let me help you explain. Okay. There's a concept called net amount at risk. Net amount at risk. NAAR. This is that more insurance equals more payments conversation. Essentially, the net amount of risk is how much does the insurance company have to pay when I die? How much are they on the hook for when I die? That's what this is the conversation. Okay? How much does the insurance company have to pay when I die? In the bottom example, it's easier to calculate. How much does the insurance company have to pay when I die? Well, if 25,000 is mine and 125,000 goes to my family, they have to pay out 100,000. Everybody with me on that one? They pay 100 because they're adding my cash value on top. Okay. The second one, a little bit more complex. If I make up 25,000 of the 100 and they're only going to pay 100 to my family, how much does the insurance company have to pitch in? Well, they only have to pitch in 75. They're only topping up to 100. So if more coverage means more money, Eric, which one costs more money? Well, death benefit account value is more money because there's more insurance. Now let's go one stage deeper. Eric, what happens when my 25,000 goes to 50? What happens when it goes to 75,000? If my account makes up 50, does that mean the net amount of risk goes down to 50? Yes. If my value goes up to 75,000 and I'm up 75 to 100, does that mean my net amount of risk goes down to 25,000? Yes. And if less coverage means less money, does that mean they charge me less money? That's exactly what it means. So let me say this really clear for you. If they're asking you to calculate the cost of the insurance vehicle, make sure to figure out how much net amount of risk it is, because that's the amount the insurance cost is, not on the full 100. So if they say something like, what's the cost of insurance for this policy? If some of it's your money and some of it's the insurance money, you better only calculate on the insurance money, not the full face value, because some of it might be yours. But what happens on the death benefit plus account value? Well, if this grows to 50, this grows to 100, what happens? Well, they still got to pay 100 in insurance because they're adding the cash on top. It's just the amount that goes to the family that goes up. So on the other standpoint, keep in mind, if they die in a universal life, is it a death benefit or a death benefit plus account value? Because if it's account value, you add the two together. If it's not, they just get what the insurance amount is. Everybody seeing what I'm seeing? If they die plus the account value. On the cost of insurance, the death benefit one, they only pay for the insurance portion in premiums. The more you take over, the more you don't have to pay. Let me say it this way. The top example is like renting on your own insurance. As you grow your investment inside of there, you are slowly taking over more and more of the insurance, which means you pay less and less insurance premiums because there's less and less insurance involved. In the death benefit account plus account value, you will always pay premiums on the 100,000 because they add your cash on top. In the death benefit one, you only pay the portion of the part of it that's insurance. On the bottom one, there'll always be insurance every single time. Death benefit, as your investment grows, you take over more and more of the insurance. I'm not answering questions right now. And then in the death benefit, it just grows the amount that goes to your family over and over and over. It's just where does the investment go to? It does make up part of the death benefit to your family when you pass, or does it get added on to the death benefit when you pass? That's the difference. The reason why it's complicated is sometimes they ask you, what's the net amount of risk? And you need to figure that out. How much is the insurance on the hook for if you pass? And that net amount of risk, that's the amount you pay in the insurance amount, not the full amount. All right, we got two more to go into. Going fast. We got two more. Here, maybe I'll scroll back so in case anyone needs to write. There's also death benefit plus cumulative premiums. Like I said, I'm not answering questions right now. It's about listening right now. Death benefit plus cumulative premiums means it adds a premiums on top. So it's kind of like a return of premium in a way. But the net amount of risk is always 100,000 here still, because the insurance, sorry, I'm making it red just so it's easier. But it's kind of like a return of premium in life insurance where they add the premiums. Every premium you make means the death benefit goes up a little bit. So it'll slowly kind of go up like this over time. No, I didn't mean to make that. Every premium you make makes the death benefit go up a little bit because they give you the premiums back too, or it's a portion of them. And then the last one in here is called an indexed death benefit. Where the death benefit, it's indexed. And if you remember index yesterday, index annuities, what did that mean? It means it grows yearly. So the death benefit will just grow over time. Every year it grows. Index means grows every year. Index means grows every year. So you're either going to get the death benefit with some of it being your money, some of it being the insurance. They're either going to give you the insurance plus money you have in there. They're going to give you the amount of the insurance plus the premiums, or they're going to give you the amount every year. And we pick them when we buy them, and we don't change them. The only thing you can change in here, or one part you can change, is you can change level or Y or T at any time. So you can go yearly renewable term and then switch it to level if you want, or go level and then switch it to Y or T if you want. You can do that. Okay. These are 4 options. Universal Life has flexibility, and it also breeds complexity. Okay? I'm not trying to paint these as simple, but I'm trying to simply explain them, and I'm not answering questions yet. Thank you. I know it's hard sometimes. Is everyone grasping the concept of these? And by the way, you can search any of these in the textbook and they'll show you little graphs to show you how to do it. They're there. If you need to review them, it's okay. The main 2 that they're going to mention in the test is these 2. Just be careful, because if you die, a death benefit account, they add on top of each other, both. In the death benefit, they don't add on top of each other. They're part of each other. Okay? Index means it grows yearly by a percentage, usually the consumer price index or inflation. Sounds really small because I zoomed out, but I'll make it better. Inflation. No 5-minute break. We don't have time for a 5-minute break, unfortunately. If you have to take a break, you can, but we're going to soldier on. These 2. The ones that I want you to focus on understanding. The other 2 you can search. These 2 you should know because they're going to show up. Yeah. Okay. We're going to keep going. I will open up questions now, but we're going to talk about loans now. It's okay if I roll past this for now. We're going to get into loans, and I'm going to write down the loans while I answer questions if they come in. But keep in mind, I'm not going to answer a bunch of questions about hypothetical situations. This is only for universal life, correct? How do you calculate that amount for insurance? You don't worry. We're going to talk about how to calculate how much insurance soon. I got you. That's coming up. Okay. Let's talk about loans. Now, I want to give everyone a little bit of a real life example so everyone can understand why this is important. I have a blue sticky note sitting on my desk. And this is a sticky note that I had sitting behind my camera for almost 2.5 years now. The reason why I have the sticky note is this is a client that in their universal life plan called me and wanted to cancel their entire plan. They said, Eric, I got to take out all my money. And it was mid-COVID. And I asked them why. And they said, well, I need to pay off my family's bills because they didn't work during the pandemic. And I said, wow, that's really nice. But how about we do a policy loan and loan against your funds inside of your account? And they're like, oh, I didn't know I could do that. I thought I just had to cancel. So let's do the loan. And I said, okay, great. That way his insurance doesn't go away, but he gets to use some of the funds that's inside of that. And the reason I have the sticky note is because in December 2023, he sent me a text saying, I have a year and a half to live. What are my options? And what's on the other side of the sticky note is all of the details of his insurance plan that I knew I needed. And I stuck it behind that camera for a year and a half. Unfortunately, there's a reason why the sticky note is still in my hand right now and not on the wall. He passed away. And I'm helping his family get the funds from this plan. So keep in mind that as much as this is a concept for you, the problem with permanent insurance sometimes is if we put all of our clients' money in permanent insurance and don't invest it in short-term savings, they'll cancel the long-term savings to fill short-term things. And this is why education is really important, because if I didn't educate my client on what his options were, his family would have received nothing when he passed, because all that money would have been gone. So let's try and be part of the solution, not part of the problem. Yes? Don't put all your clients' money in long-term things. That's like the drawback of permanent insurance. If you put everything in the permanent 20-year option, they don't have any money to put food on their table today. You got to open up for both. So I'm going to show you the example of what happens for this client now that he has a loan when he passes away or if he cancels. We're going to talk about that. Now I'm going to put his name as John. His name's not John, but let's just say it's John for this example. Okay? I'd say I had a $250,000 policy. For level death benefit, if the account value is more than the death benefit, will the extra money be added to the death benefit? Yes, Shaw, that would be true. He took out, or sorry, let's say he has 100,000 cash surrender value. So the amount of money he has in his investment is this. And he took out a $50,000 loan. What happens when he dies? What happens when he cancels? If he cancels his policy with a loan. Let's talk about passing away first. It seems to make more sense or easier. If he passed away, his family gets the policy, the $250,000. But the loan has to get paid back. But the interest on the loan has to get paid back. And his family gets the rest. This is loans. You got it. So let's say it's $50,000 for the loan, and let's just use $1,000 for interest just to keep easy math. This is an example. That means his family would receive $199,000 from the plan. And the beneficiaries don't pay tax, right? The loan and the interest gets paid back before the family gets any money. This is not a family gets $250, pays the loan, pay the interest. No. It means the money goes, the loan gets paid, the interest gets paid, and then the family gets paid. They become the rest. Now let's talk about what happens when he cancels. When you cancel your coverage, you get the cash surrender value. That's why it's called cash surrender value. It's the cash value when you surrender, cancel the policy. So he would receive the $100,000, but the loan's got to get paid back. But the interest has got to get paid back, and you receive the rest. So be minus the $50,000, minus the $1,000, $49,000. And relax. Before tax. This is a poly loan. He borrowed from the insurance company he was working with. Okay? So he wouldn't even get the $49,000. There would be tax to pay here, and we'll talk about the tax next. But here's the premise. This is why loaning can be good. His family received a heck of a lot more money than if he just took the money out by himself. I'm pretty glad I asked why when he called me and said I need to cancel. Thankful I made that phone call. Now, here's the part with the death benefit plus account value for those of you that are wondering, okay? If this was a plus account value option that we just talked about, you would add the 100,000 cash surrender value because you add the account value on top. That's how you can get them wrong or get them right. Really easy. Because if this was a plus account value, you would add the cash value on top because they add the investment on top. Now is that making a little bit more sense? Tangible example? They add the cash surrender value when they it doesn't change anything on the cash surrender value side when they surrender because you just get the cash. It matters on the die side because they add the cash on top. All right, good. Everyone okay with loans? Loans always get paid first. Interest gets paid. Family gets the rest, or you get the rest, depending if you cancel or die. Good. All right, awesome. We have 2 more things really to go through, and yes, unfortunately, there's going to be a little bit of math. Ooh, I know. Get ready. What's the tax implications of a policy loan? We're going to talk about the policy loan tax implications in a second. Don't worry, we're going to talk about that. You want to know what the tax implications of a policy loan is? You can loan up to your ACB, your adjusted cost base, tax-free. Above, the extra is taxed. So if this client had a $50,000 adjusted cost base, they could loan up to $50,000 tax-free. But if they loaned anything above the adjusted cost base, they will pay tax on the overage. And this is the same for universal life and whole life. Yes, Vanessa. We're talking universal and whole life now. Both. Plus 100K is only for the death benefit. Right. You got there would be no plus 100K on the other side because that 100K is already used. You can loan up to your adjusted cost base tax-free. If you loan anything above that, you are paying tax on the overage. Clear? Awesome. And this is policy loans, not collateral loan with the bank. I would recommend you read collateral loans on your own time. And it's taxed as just like RSPs, Samantha. Full tax. No half tax here. Yeah. All right, can I roll through? Let's go. Let's do this. Here we go. We're going to talk about premiums one more time. You can get a loan in a universal life and a whole life. Yeah. Let's talk about premiums, insurance, and investments one more time, and then we'll leave it alone. Okay. Now we talked 130, 40, 90 as our universal, right? Okay. If you need me to go back to something and so you can look at it later, we can look at it later. Trust me, I got like 25 minutes worth of stuff, and we are not having 25 minutes worth of time. So stay with me. They will give you totals now. In the course, they will give you totals, not monthlies. So they'll say total premiums. Let's say it's 15,000 is the total premium. Your 130 added up to total 15,000. The insurance column total is called net cost of pure insurance. NCPI. I like to call it pure insurance cost because it just makes more sense in my mind. Pure insurance cost. The words are in there. Let's say it's 5,000. So that means of the 15,000, 5,000 went to the insurance side, which means the other 10,000 goes to the investment side. The 10,000 that we're going over right now, the name of it is the adjusted cost base. The ACB, the first thing we just talked about, and the thing we talked about in the loan. The amount of money you've put in through $90 per month payments. The amount you've invested in. And what do we say about adjusted cost base? It is tax-free when you sell it, which is true. That's why you can loan your adjusted cost base tax-free, right? But let's say the cash surrender value of your plan is 50,000. So it's funny. I know the questions are coming. It's awesome. I just see the future. So 10,000 is how much you've put in. 50,000 is what it is worth after growing, after accumulating, what it's worth today in the market. Because in universal, it can grow percentage. So I've put in 10, but right now it's worth 50. Everybody with me on that? Okay. the difference between these two numbers, if you were to sell the entire policy, if you were to cancel your entire policy and take all the cash out, this is 40,000 is called a policy gain. Put green question marks. They might ask you, what is a policy gain if they cancel their entire policy? It's the difference between how much you've put in and how much it's worth at that time in the cash. Your gain, your growth. And the policy gain, when you cancel your policy, is taxed. Fully taxed. No half tax here. Policy gains are full tax. Capital gains are half tax from yesterday. They're different. So this is full tax on the policy gain. And they might ask you, how much tax? By the way, if you want to practice this, this is chapter 7, that life insurance taxation principles. How much tax do you have to pay? They might ask, how much is left over? Or write that better. How much left after tax? Well, if you want to figure out how much tax, you take the policy gain, which is 40,000, and you multiply it by the tax rate, which let's just throw a 30% in there. It's whatever tax rate they give you, 30%. So that would be 12,000 in tax. They would pay. They might ask you how much tax. They might also ask you how much is left over after taxes, which is how much is the client going to get? Well, then you would take your cash surrender value, the total amount of your investment, minus the taxes. So it would be the 50,000 total amount, because you get that 10,000 in your bank account with it, minus the 12,000 taxes, 38,000. And it goes through this process every time. And yes, it will take practice. And no, I'm not going to do an example yet because we don't have time. You take the policy gain, the difference between the two, you multiply it by the tax rate to find out how much tax they pay. And then if they still want to know how much is left over, you take the total amount of the money and you take the taxes off. Everybody kind of getting the process. Complicated to simple process. Okay, now I'm going to go one stage deeper just for a second. Sometimes your client doesn't want to cancel everything. They want to cancel half, part of it, kind of part of it. Stay with me when I explain this. So I want you to think of a policy when they cancel like a two-tiered cake. This is what a slice of a two-tiered cake kind of looks like. Everybody know what I mean? Like a chocolate layer and a vanilla layer and then the icing. Okay, cool. When you take a slice of your policy out, there's a part that's your taxable part, the gain part. And then there's a part, the ACB part. And every slice you take a slice of both. So here's what I want you to do. And hear me when I say this. If a client takes part of the policy, do the math for the entire cake, like we just did, and then portion it. If they took out 30%, times the number they need by 30%, and it'll be right. If they take out half, times it by 50%, and it'll be right. Bake the entire cake, then portion it, not the other way around. Right? If you're making a cake for 15 people, you don't think, well, one person's going to have 3 grams of flour, so I got to go 3, 3, 3. No, you do the whole thing. And you bake the whole thing, and then you cut it for them. Do that. Keep it simple. Keep the process the same, and then slice it at the end. And by the way, the icing is the insurance policy. So if you take out 50% of the money, you also cancel 50% of the insurance policy as well. Why do you use the full cash surrender value, figuring out what's after tax? Because they're asking you how much goes in the client's bank account after tax. It's not just the policy gain that goes into their account. It's just a cost base included. So you have to do the full 50 minus that tax amount. Yeah. Because they're asking you how much will the client get? Well, they get that 10,000 ACB plus the rest after taxes. So you just include the total amount. Yep. Everybody okay on this process? You're going to need to practice it maybe. And if you want to practice it, Chapter 7, chapter quizzes, Chapter 7 chapter quizzes. Take the process and do it. Can you explain if you want to cancel half? I explained that already. You do all the math and then you cut it in half. Cut the numbers in half. Yes, when you withdraw money out, you also reduce the insurance amount as well. That's the icing on the cake. If you cut the money, you don't leave the icing if you eat the cake. Take the icing with you, which is the insurance policy with you. So the coverage gets reduced as well. Everybody okay? Good. Take a deep breath. We're almost there. We got one more thing to go through, and it's a little bit of a doozy. But has everyone got this down? All right. So I'm gonna let everybody know what we're gonna do next. We are gonna calculate how much insurance we do for our clients. And this is probably the most complicated math thing we're gonna do this entire weekend. But I want you to breathe. Okay? What we're gonna do is I'm gonna explain it. And then we're gonna take our break, and then we're gonna come back and do a couple examples of it, and then do the mock exam. Okay? Here we go. The how much insurance conversation comes in 3 parts, but 2 are very similar to each other. The first one is the assets minus liabilities conversation. Assets minus liabilities, or the capital drawdown is what they'll call it. You take what they own in things and life insurance and minus what they owe in debts and needs of life insurance. And if they're in the negative, they need insurance for that amount to make it 0. These ones look a little complicated, but they're not complicated because you add the house minus the mortgage, add the car minus the car loan, add the investments minus the debts, add the insurance they have minus the insurance they need. And if they're in the negative, they still need insurance to make it 0. So it'll look like lots because it'll give you lots of stuff, but it's not lots because you just plus, minus. See what's left. Yes, capital drawdown, you're right. Everybody get what I'm saying? Plus some things, minus some things. If they're still in the negative, they need insurance to pay for those minuses so their family doesn't have to. Okay, good. The second one is called income replacement. This is the one where things can get a little bit complex, but I'm going to break it down simple. As always, they call this one capital retention. They will use both words. Okay, just show. Income replacement is the conversation that I want my income to continue on when I'm no longer there with my family. So I want my 50 grand a year wage to keep paying to my family when I'm no longer there. So what I'm going to do is I'm going to buy $1 million worth of insurance, and I'm going to tell my family when I pass away, invest that $1 million, earn 5% on it every year, and they'll earn my $50,000 life forever. Do you get what I'm saying? $1 million, they take 5%, it pays the 50. Okay? They'll give you the 50,000. They'll give you the 5%. They want you to calculate the big number. So let's walk how to do that. Okay? Let's walk through how to do it. The first option is when they only give you the interest rate. Only. The other one is if they want you to include taxes and inflation. Or inflation at the same time. I'm going to put some numbers over here that I want you to write down that we're going to use for these examples. Okay? We are going to use an income of 60,000. We are going to use an interest rate of 5. When we get to the taxes, we're going to use taxes of 30%. And we're going to use an inflation of 2. Okay? You'll know whether taxes or inflation are told to you because there'll be more percentages in the question. If there's only 1% return, well, you probably don't need to deal with taxes and inflation. But when they add taxes, which are 2-digit percentages, and growing money over time, we'll get there. But in interest rate, if there's no taxes, no inflation, it's no problem. You take the yearly income, which they'll give you, or they might give you monthly that you have to make yearly, and you divide it by the interest rate. That's it. So I would take my 60,000 in our example, divided by my 5% in our example, and that would give me 1.2 million. And that'd be the answer. That's it. That's it. That's all. 1.2 million divided or times 5% equals 60,000. My 1.2 million will give my family $60,000. Yearly income divided by the interest rate, amount of insurance. Everybody okay with that math? And they'll give you the numbers. Okay? Don't have to pull them out of thin air. All right. Now let's talk about when there's taxes and inflation. We are going to use a 3-step approach because I like things in threes. I don't know if you've noticed. I like to do steps of 3s rather than 4s and 5s. Okay? The first step is we're going to deal with taxes. The second step, we're going to deal with inflation. And the third step, you already know, yearly income divided by the interest rate. The interest rates they will give you will be fixed. Yeah. Okay. We know this one already at the bottom, right? Now, with this conversation of taxes or inflation, the 60,000 does not change. What is going to change is the rate. Let me tell you why. Because part of that 5% rate is going to go to pay the taxes. So that's not going to go to the family. Part of that 5% is going to go to paying for inflation. So that's not going to go to the family. So we can't include the full 5% in giving them 60,000 to the family. So we got to make that 5% a little smaller, a little smaller, and a little smaller. Okay? Now, we're going to keep it simple. Stay with me. I'm going to write them in words. I'm going to zoom into. I'm going to write them in words before I write it in math. And don't worry, you guys have done math like this already, or you do it every day. It's okay. Everybody breathe with me for a second, because I can tell the anxiety in the room is going up. Okay. We need to discount our interest rate by the taxes, because that amount is going to go to tax. So I'm going to take my 5%, well, just 5, and I'm going to figure out what 30% of it is, because 30% of it's going to go to taxes. Everybody with me when I say that? 30% of this 5 is going to go to taxes. So I need to take that off. So I figure out what 30% of 5 is, 1.5. And if you're like, Eric, I don't know how to do it, you do it every time. Make it 30% off, like you're discounting it at a shop. And then take it off. So that means 5 minus that 1.5 leaves me with 3.5% after taxes. I took off 30% of the interest because it's going to go to taxes. Everybody still with me? Okay, good. Now, just so we're clear, if they only give you taxes and they don't give you inflation, you don't need to do inflation. If they only give you inflation and they don't give you taxes, you just do inflation. If they don't give you either, you go right to step 3. But taxes before inflation, if they give you both. Taxes before inflation, every time. Otherwise, you will get it wrong. Taxes before inflation. We okay? All right. Now, this is where we're going to get a little bit math heavy for a second, but it's not going to be scary. Stay with me. There will be sometimes taxes plus interest plus the inflation rate, and we are going to do some together. Don't worry. That's why we're going to take our break once we do this, and we're going to do it together. All right, here we go. To do taxes, what we need to do, and we've done this math already, we take our interest rate, which is our 3.5. Okay, we are going to take that and put a 1 plus beside it, just like we did with the compound interest. So that means this number will be 1.035, very similar to what we did with the compound interest yesterday. And then we're going to take our inflation number, which was 2%, and we're going to do the same thing on the bottom, 1 plus 2%, which will be 1.02. Everybody see what I'm seeing? We divide this number by this number. Okay? This will give us a number. I'll put in my calculator. We'll do it together. Okay, here we go. 1.035 divided by 1.02. This gives us 1.147, okay? Or 1.0147. The number you're looking for is the one without the 1. Here's your percentage left over. So this number is, sorry, I'll just get rid of this here. So the number it came out is 1.0147. Everybody see? We take the 1 off of it, because that's what we just need to do. Here, let me just make sure I got the right color. I'm just making sure my colors don't match. We're going to take the 1 off. And this is a percentage now, which is this, because this equals 1.47%. Remember how percentages, like 1.03 is 3%? This is 1.04, okay? Everybody kind of okay how we did this? We took it 1.0 this, divided by 1.0 this. I know it's a little complex, but stay with me. Everyone's like staring at me like I'm crazy. Okay. Listen to me one more time. You put the interest rate in with a 1 at the top. You put the inflation number with the 1 at the bottom, and then you divide the 2. And then you take the 1 away. This number, 1.47, that's our final number that we type in down here. And we'll get our number. So here we go. 60,000 divided by 1.47%. Could be about that number. Now, here's the thing in the here. I'll show you this guy here. Okay. Here's in the textbook. So you can read it in the textbook if you need. Okay. We take our after-tax rate of return, which is 3.5. We divide it by our 1 plus our inflation. And then there's this little guy right here, which looks almost the exact same as we did, to give you a number. And then you take that number and calculate it in the end. Is there an easier way to do it? Kind of, but the thing to keep in mind is this will get you the number basically right to the penny. But I would say try and keep as many decimals as you can in the attachment so it gives you the right number. Okay? Everybody all right? We're going to do something together. But we're going to take a break first. I'm going to pull this up. I'll leave this up for everybody. I know it might not sink in right away, but we're going to do it together. Okay? We're going to do something together. So we're going to take a break. 5 minutes. 12:06. My time. See everybody in 5. All right. We're back. Right. So I know we were a little bit knee deep in math at the end. So what we're going to do during the mock exam part today is we're going to do some examples together and work our way through so everyone can understand the process as we go through it, okay? Because I don't know about you, but sometimes those numbers look a little scary to me sometimes, no? Anybody else with me? The math at the end looks a little scary? All right, good. I'm not the only one. So let's pull this guy up. So what I'm going to do is I'm going to pull up a chapter quiz in chapter 11. So if you wanted to practice these questions specifically, chapter 11 is the place to practice some of these, and we're going to do some of those together. So I'm going to pull up chapter 11 because the chapter quizzes are awesome if you use them, and we're going to walk through them together. Am I still sharing? Perfect. You guys can see this, yeah? Perfect. All right. So we're going to work our way from the easy ones to the hard ones, okay? Let's go. So let's go with number 2. Now, what I'm going to do just to make things a little easier for us is I'm going to put squares around the numbers that matter just to speed us up, okay? We got a return of 4%. We have a $7,000 per month income. And they're saying using income replacement approach, ignoring inflation, calculate the amount of life insurance they need. So how we do this is we take the yearly income, which would be $7,000 per month, times 12 to make it yearly, right? And then because we have no taxes, no inflation, we got no problems. We just divide it by 4%. We've all $1 million. That's it. Income yearly divided by the interest rate. That's the answer. Easy peasy. No problems. Everybody okay on that one? Yeah, that one's all right. We're not scared of that one. No taxes, no inflation, no problem. Okay. Now let's find another one with, I'm gonna have to refresh. Here, give me a second here. Let me find it so you guys don't have to see me go all the way through it. Okay, good. Let's find one with taxes. Here we go. Now, yes, I know when you look at these, they look a little scary, right? Remember we talked about this yesterday? If the ones that look like they're going to take you a little bit long, but you look a little scary, make sure you're like spending time on those ones when you can near the end of your exam so you can spend time on the easier, quicker ones first so you don't feel like you're running out of time. But this is a taxes one, not an inflation one. So if I put the squares around it, I might say, well, Eric, there's actually 2 tax rates. Which one do we use? And there's actually 2 incomes too, Scott and Amos. Move calculator. You could ask nicely, but I'll move it over for you anyway. Okay, so we have 2 tax rates and 2 incomes. So let's figure out who's passing away. And whoever's passing away, we're going to use their income to replace. So Scott's worried about his income. So that means we're not going to use his wife's income. We're going to use Scott's. Now you might be saying, well, Eric, which tax rate do we use? Because he has 2. The program I'm using to make these boxes is Zoom. I use the annotate function on Zoom, Lucas. That's what I'm doing because I'm host. Okay. So you can't do that during the exam, right? Can only do this on Zoom. That's okay. So during 2 tax rates, here's the part I want you to understand. The high income earner has a high tax rate, right? The low income earner has a low tax rate. Everybody kind of get with what I'm saying? When you make less money, lower tax. When you make more money, high tax. We do not want to use the dead person's tax rate. So let me say it a different way. If the high income earner is the one passing away, we are not going to use the high tax rate. If the low income earner is the one passing away, we are not going to use the low tax rate. Don't use dead people's tax rates. So since Scott's the one that's passing away, the high income earner, we are not going to use the high tax rate. Now you might say why? Because Scott's not going to be alive to earn it at that tax rate. His wife is at the low tax rate. So we don't use the dead person's tax rate. We use the person who's going to be alive getting taxed. Their rate. Everyone with me on this? Don't use dead people's tax rates. So we're going to get rid of this one. So we're going to do the same thing we did with number 1. We need to discount our 3% by 35%. So I take 3 and I multiply it by 35% to figure out what portion is going to taxes. 1.05 is going to taxes. So I have to take that off because that's not going to go to the family. What's left over is going to go to the family. So 3 minus our 1.05, that leaves us with 1.95 left over. Now there's no inflation to deal with, so we don't got to worry about that. So we just go right to step 3. 125,000 divided by our 1.95% equals 6.4 million. Hey. Everybody all right on that one? Discount the interest rate by the taxes, yearly income divided by what's left. Easy. No inflation, no problem, right? Okay, A, perfect. Where did the 1.05 come from? That came from 35% of 3. 3 times 35%, which is the taxes we had to take off. That's the portion of our taxes, or that 3% we have to take off. We have to discount it by 35%. This is 35% of 3. So then I had to take 3 minus the 1.05, the part that goes to taxes, 1.95. Then I do the 125,000 divided by 1.95%. $1.4. Why didn't I use the marginal tax rate? Because the high tax rate is Scott's, and Scott's going to be dead when this pays out. So we don't use Scott's tax rate because he's not going to be there. We use the living person's tax rate, the lower income tax rate, because the lower income is going to be alive. We'll do it one more time. We'll find another one. Hold on. I'm with you. Here, let's pause it so I can get the right question. Which one is it? Yeah, let's do this one. Let's do number 1, which is just inflation. Just inflation. No taxes, just inflation. So we got salary monthly, 5,000. This salary will rise by 3%. That's inflation. And 4.5% is the rate. So we got to do this guy. So we take 1.045 for 44.5%, right? We divide it by 1.03 for 3, and that gives us 1.1456 blah, 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 blah number, right? Now you can round this number if you want, but keep in mind, if you round it, it's not going to be right to the dollar, but it's going to be this close. So what I would do is I would round it to 1.46. That's what I would do. So that's what we're going to do, 1.46%, because we take the 1 off, okay? So we're going to go our $5,000 per month times by 12 to make it yearly, divided by our 1.46% equals 4.19. Now we know it's not exact. We know it's going to be really close. Which answer is the closest to this? B. And if you didn't round it, it would be exact. Everybody with me on that? It might not be exact, but that's because you rounded it. If you didn't round it, it's exact. But it's okay to round it a little bit as long as you know that you're going to have to check the answer at the end. So I'm going to do it one more time for everybody's with me. I have to add 1 to the percentages to do this. I add 1.045, 1.045 for the 4.5% because you have to add 1 on the top. Then you divide it by 1.03, 3% on the bottom, equals. This gives us our 1, but we take the 1 off, right? So it's not 1.1. It's this. Let's go if we go minus. Here's our percentage, okay? But I'm going to round it a little bit. So I'm going to go 1.46% just because I find rounding a little bit easier. But I know that that means my answer is not going to be exact. So then I take my $5,000 per month, times it by 12 to make it yearly. Then I divide it by that 1.46%. And it gives me a number really close because I rounded it, which means I'm a little bit off. 4.12. Everybody, okay. And they're going to be really close when you round it like that. That's rate of return with a 1 divided by inflation with a 1. Take the 1 off at the end. That's your new percentage to take to the end. Everybody okay? Okay. It's going to take practice. But as long as you have the process down, you might need to practice. So we're going to do one with both. I'm going to find one with both. We're going to do them both. Let me find it. There you go. 7,000 per month, 2% raise of inflation, 5% interest rate, 25% tax. We're going to do it all. Here we go. Let's do it. So our 5% interest rate, we need to take off 25% of it because of taxes. So 5 times 25%, that gives you 1.25. That's going to taxes. We have to take that off. 5 minus our 1.25. That leaves us with 3.75. Everybody with me so far? Taxes are not so bad. All right. Then we do inflation. So what we do is we take our 3.5%. Oh, sorry. We add 1.0375, 3.75%. Then we divide it by the inflation rate with a 1 added, 1.02 equals, that gives us a number with a 1, but it's 1.71568%. So I'm going to round it to 1.72. Is that okay? Knowing that we're going to be off a little bit. So now I do step 3. I take my $7,000 per month, I times that by 12 to make it yearly, and I divide it by my 1.76, I think was what the percentage was. Let me just make sure I'm not crazy. 1.72. Okay, I'll do that again. 84,000 divided by 1.72%, 4.8 million. Which answer is about 4.8 million? B. It's actually, because the answer is actually 4.909 million, but they rounded up. So it gets you right there. And if you don't round, you'll get the number exact. But it's really hard to take a number with 16 decimals at the end and type that back in the calculator, isn't it? I think so. The history will not be on a calculator that you get in your certification. You should just try and write that number down if you can, showing a blank sheet of paper, if you can, to the camera, right, so they know it's blank. Or if you're in your provincials and you're in a paper exam, write it down on the piece of paper. Why are we multiplying 5 times 25%? Because we need to take off 25% of the tax, because that part doesn't go to the family persona. So if we do it one more time, I take the 5% interest that needs to get reduced by 25% due to taxes. That's step 1, times 25%. So I have to take off 1.25 because that portion of the 5 is going to taxes, not to the family. So I got to take that part off. That leaves us here. Okay, 3.75. Now we got to do inflation, where I have to add 1.0375. I got to add a 1 to it, divided by 1.02, because I had to add a 1 to inflation, 2%. Equals, it gives me this long number. It gives me 1.72%. And I take that to the last step. I take my $7,000 per month, times it by 12 to make it yearly, divided by my 1.72 rounded percent, equals. And then I'm looking for a number just above this, because when I round it, means I'm off a little bit. Which one's the closest? B. That's how you do it. Is it going to take practice? Yes. Is this the hardest math of the entire course? Yes. So if you don't understand it, it's okay. But it's going to take practice to do it. Everybody okay? All right. So you just got to practice. And if you want to keep it exact, hey, all the power to you. But I round it so I know where I'm at and I find the answer that fits the best. That way I'm doing the math the way that they want, but I'm rounding it a little bit so I know I'm close. Are the examples in the chapter quiz? Yes. Yes. Lenora, the after-tax income doesn't matter because this is how much they want to replace to their family. So don't worry. It's chapter 11 you got to practice, okay? Everybody all right? We're going to do the mock exam now. We just focused on this for a little bit, and we still got plenty of time to go. All right, good. Let's get this away. That's only one concept, and I'm not going to spend the entire time on one concept. We got mock exam to go through. So let's do this thing. All right, mock exam. Where's my textbook? Bam, here we go. Let's go. All right. Can you also do like what the monthly is needed, also monthly most approach? You could try different methods that might work for you, but that's the method they want you to use in the text. Yeah. So that's what I'll show you. Well, that's a little bit small. Okay. Everybody ready to get going? Let's do this. We're going to see if we can still get 10 questions done. Now, considering Judith's desires, here I'm going to move this up, and current situation, what type of life insurance would be the best option? We talked about keywords, right? Keywords for term, debt, mortgages, children's education, spousal support, whole life, funeral expenses, charity of death, or charity, taxes at death, leaving estate, universal life, flexible premiums, investment focused, high risk. Now, let's see, I'm looking for those things as I go through. Judith's 30, and she completed her PhD in economics a few months ago. She started her career as a university professor. She's still paying off her student loans and took out a mortgage loan to buy a house with her husband. Mortgage means term, in my mind. She's also paying debts. Debts mean term. Judith has started investing for retirement, which has not left her with much disposable income. She wants her children in the next, so she wants to have children in the next couple months, and Judith wants to make sure her family does not suffer financially if she or dies. So she needs life insurance. She also wants to be able to leave a large charitable donation. Charity donations mean what? Whole life. To the university to help fund scholarships. Considering Judith's desires and current situation, what type of insurance would be the best option? Well, they said term things and they said whole life things, but there's no whole life and term things. So which one do we choose? We picked the convertible term, the one that can be term now, that can be permanent later. Heck yeah, you guys listened. I like that. Right? Because she doesn't have disposable income. She doesn't have a bunch of money to buy permanent now. This is why the keywords are awesome. Everybody all right? Going with B. This is how we do it. This is how we get it done. Seems scary, not so scary. All right, let's do this one. Which type of rider is the most suitable for Binju? And by the way, if you don't recognize some in here, that's what we do when we don't recognize things. We search them. So here we go. June meets his new clients, Binju and Seema, a young couple with 2 children. Binju's employer provided a non-contributory group life insurance plan with a death benefit of 2 times Binju's salary and 60% disability. Okay, so he's got some insurance. His life insurance benefit will increase as his salary increases. So that means it will index with his work, right? He analyzes the couple's financial situation and determines that Binju should carry an additional $750 whole life. By the way, no numbers in the answer, not about the numbers in the question. So $750 might not matter that much. To support his family in his death. What type of rider is most suitable for him? Well, there might be some in here that you don't recognize, like dread disease benefit. Anybody with me on that one? I don't know what that. Okay, let's go look it up. Now, we're not looking to become experts. We're looking to, does it fit Binju, right? Dread disease, aka critical illness. Well, let's do this without reading it. Does Binju need critical illness? That's a question to ask. Okay. Some of us say yes, some of us say maybe, some of us say no. Okay. Maybe look up this. We'll look 5.2.1.1. For those of us that weren't here yesterday, you can put the section numbers into search. 5.2.1.1. One of 2, and then you just go to the next one. Terminal illness benefit is a disease or sickness that causes death in the foreseeable future. The terminal illness benefit allows them for an advance of the death benefit if the life insurer is being diagnosed with a terminal illness that they're only expected to live 1 year to 24 months. Now, I want to make sure everyone understands what these accelerated death benefits mean. That means they're paying part of the death benefit of your insurance up front. So if it was a $400,000 policy and the terminal illness paid out $200,000, that means when they die, they only get $2,000 because they paid $200 of it up front because you're going to pass $200 when you pass. Everyone get the idea of advance or accelerated death benefit? Great. The dread disease does the same thing, except it's like a critical illness one. When you get a critical illness, it is an acceleration of the death benefit. So it pays part of your death benefit up front. So instead of having CI maybe, or in addition to having CI, this can pay out part of the death benefit. Everybody with me on what those mean? Okay, do those apply to Binju? Is that going to solve his problem? I don't think so, because he didn't say anything about worried about being sick, worried about dying too early. He's not sick or dying. Now, could you buy term insurance? Yeah. but he wants to support his family, right? Now he might say, Eric, what's the family coverage rider then? Well, let's go find out what that is. Family coverage. Family coverage rider. 5.1.2.3. Well, I'm going to use the sidebar to get this one. Open the sidebar, pick the second one. 5.1.2.3. Family coverage rider. The family coverage rider is a common addition to policyholders who have a spouse and children. It's sold in units. It allows them to cover their spouse and their child. Would that be good for Benju? Yeah, I'd say so. So I'm going to go D. I think that fits in better. Everybody okay? Yeah, we learned what those other things were, but we're applying it to this question, right? Now, during your mock exams and chapter quizzes, feel free to read up on things when you read them in the text. But when you're in the certification and the provincial, I really want you to understand that it's not time to learn more new things. It's to put what you know on the page. Someone said, hey, Eric, you can click on the table of contents. You can in your textbook, but you can't in the provincial textbook. So I don't go by that. Can't click on the topic. Provincial stuff. Not everywhere anyway. I like to show ones that work. Now, this one. How many of us would look at this one and say, Eric, this is going to take a while because there's some numbers and it's scary and I don't like it? No? How many of us would be like, but I'd tackle it anyway? All right, for the people that say, but I'd tackle it anyway, let me ask you a question. Is this going to take you longer than 2 minutes to complete? If for the people that are saying no, do it right away. For the people that are saying yes, you should skip it then because you don't have time to waste until you have time extra to waste. Let me tell you the number one thing that people stress about in the provincial, the time. When they look up and they're behind, they are freaking out the rest of the test. So try and get time back by doing the easy questions, then working at the hard ones. If you're a math person, you can do it right away, do it. Everyone's got different strengths and weaknesses, but let's go. There's a weird compulsion that people want to do math when they don't understand the math because they want to do it. Don't do it right away. Do it at the end. Okay? I'm not saying don't do it. All right, here we go. Last sentence first. How much income tax would Nelson's estate have to pay due to the deemed disposition of the assets above? Anyone not know what this word disposition means in this context? This means like selling upon death in a way. That's a way to think about it, like when they sell things. Okay? So Nelson has the following accounts. RSP, Lira, non-registered account with an adjusted cost base. So he bought it for $80,000 and it's worth $200,000. It's funny how adjusted cost base comes into play. Like that's a seg fund non-registered conversation, but it's in life insurance today. Nelson Single has 2 adult children who he designated as beneficiaries of all of his assets. Assuming the marginal tax rate in the year of 47%, how much income tax will his estate have to pay for the selling of all the assets? Well, here we go. Is RSP full, half, or no tax? Full. So we're going to have to take $250,000. Is Lira's full, half, or no tax? We didn't really talk about it yesterday, but it'll come out as full tax, just like a LIF would when they take the money out. So we're going to add that on to the full tax conversation. So $350,000 of it is going to be full taxed, which let's times it by 47%. This gives us $164,500 so far. Now, here's something that I want everyone to hear me when I say this. When I don't know what to do in math next, I take a common sense step. I know this number's right. Everybody with me? You know this number's right. If I continue on in the math, what direction is the number going to go? Up or down? More tax, right? So what I would say is if any answer is less than this 164, you should eliminate it right away. And that might happen. So that way you're kind of shrinking the questions. Now, let's talk conceptually. Do we think it's going to go up by 50,000, 70,000, 60,000, or 30,000? What do you think? What's your gut telling you? Because sometimes you're going to have to go with your gut before you go do the math, but we will do the math after. And whichever one you think that is, that's probably the one you should pick if you can't do the math. Because I don't want you to struggle trying to do it sometimes when it'll just confuse you and frustrate you. You go back to whatever you're feeling right now. But let's do it anyway. Okay? How does non-register work? Half tax only on the profit, right? We talked about that yesterday. So we take our 200,000 and I minus out my 80,000 because adjusted cost base comes back tax-free. That's how much I invested. That means I have a growth of 120,000. Everybody with that? Remember, it's half tax. So I multiply this by the 47%, and then I divide it by 2, half. So it only went up by about 28,000. So now I got to add that on to my other number, 165,400. Oh, I did the number wrong. My bad. So what was that number? 250,000 plus the 100,000. I had the number wrong in my head. Equals times 47%. 164.5. I switched the two numbers. So let's do it one more time. 200,000 minus our 80,000 adjusted cost base because it's tax-free. 120,000 capital gain multiplied by our 47% divided by 2 because it's half tax. Plus our 164,500. 192,700. B. So for those of us that are like, oh, it'll go up by about 30, you were right. So if you don't know what math to do next, I want you to take a common sense step first and then try the math. And if the math doesn't work out for you, go back to the common sense one. That's what you have to pick. At least you're making an educated decision every single time. Are we okay? See how segregated funds showed up in the life insurance module today? That's why I leave it at the end. Non-registered account growth is capital gain. You got it, Miriam, just like we talked about yesterday in seg funds, if you were there. Now, this one is another math one, which we're going to do because it's not as bad as it looks. They never are. And we have talked about this part today, so don't worry. We'll be okay. What's the premium amount that Jack can deduct for income tax purposes? Jack is a real estate developer. He's borrowed $1 million from his bank. Jack uses the money borrowed to build an apartment building to generate rental income. So he's using that money to build the rental. At the bank's request, the loan is secured by collateral assignment. Oh, we didn't talk about collateral assignment, yes, I guess. So guess what we're probably going to search? That. At Jack's $2 million life insurance, it has an adjusted cost base of $280,000, a cash surrender of $450,000. Did we cash the money out of this thing? No. So the cash surrender value and the adjusted cost base mean nothing so far. Now you might say, well, Eric, you said the loan at the ACB. Well, let's look up collateral assignment first and see if that's true. But the other stuff might matter, the premiums. We'll see. Because they're asking, what is the premium amount that you can deduct? So let's look up collateral assignment. Let's see how it is. Collateral assignment. Using a policy's collateral. Nice. I'm right here. Rather than taking out a policy loan, a policyholder may also use the policy's cash value as collateral for the loan. Basically, the policyholder assigns the rights to the policy's cash value and death benefit to the lender, which is called a collateral assignment. So basically, he went to the bank and said, I have a $2 million policy. Can I borrow $1 million? And they said, yes. But then the bank becomes the first person that gets paid if he passes, because the loan and the interest always gets paid first. Everyone okay with the difference? Collateral, you go to a different company to loan. Policy loan, you loan from the insurance company. That's the difference. Okay? If the policyholder defaults, the lender can surrender the policy and use the cash surrender to pay the debt. If the policyholder dies, the lender can recover the debt from the death benefit. Okay. Now I see borrowing for business uses and deducting premiums. Or I think we're in deducting premiums because that's what they're asking us about. So let's read that. The lender will become the beneficiary, Pearl, for sure. They'll become one of the beneficiaries, for sure. If a business loan is secured by collateral assignment, some or all of the premiums will be deductible as long as the following conditions are met. A, the loan is from an authorized lender. They said the bank. Check. The lender requires a collateral assignment of an existing or policy loan. Check. The amount that is deductible is limited to the lesser of the net cost of pure insurance and the actual premiums paid. If the coverage exceeds the amount of loan, the premium deducted is prorated accordingly. This is a little bit confusing. Let me explain. The percentage of the policy they use is the percentage of the pure insurance cost they can deduct. So how much of the policy is he borrowing? Half. So what percentage of the net cost of pure insurance can he deduct? Half. So half of the pure insurance cost goes towards paying the loan in the eyes of the tax people, so he gets to deduct that. The other half of it goes towards covering your first family. Now, the trick in here is the $15,000 annual premium. That's insurance and investment. Net cost of pure insurance is the pure insurance cost that covers the $2 million. That's the whole conversation we had earlier, right? Pure insurance cost, investment section. It's the percentage of the pure insurance cost. Since it's half the policy, it's half the pure insurance. Are we clear with what I'm saying? $5,000 gets deducted. Half, because it's half of the premiums for the insurance. Everyone okay? All right. Not quite, I'm a little confused. The percentage of the policy he borrows, half, is the percentage of the pure insurance cost he deducts, half. You start hearing dogs barking because people are getting excited for some frustrating reason in my mind, but it's okay. There's like 3 other adults upstairs, and I'm the only one that can make them be quiet. It's the craziest thing. Anyway, it's the way life goes sometimes. All right. Which of the following insurance policies will address a specific concern? Remember, let's talk about those things, right? The keywords things. Abina's 42, owns a restaurant. Business at her restaurant is stable and profitable. She's very concerned about the fact that her livelihood is extremely dependent on her top chefs. Oh, doesn't that sound like yesterday when we talked about key person insurance? Oh, it's funny how things flow over, isn't it? An advisor was able to schedule an appointment with a busy restaurant owner to discuss her insurance needs. Which of the following insurance policies will address her concern? Key employee insurance. Heck yeah. And we talked about that yesterday. Yesterday was about them getting disabled. Today we're talking about if they die. But it works exactly the same. This is why the weekend is awesome, because you learned some stuff yesterday that applies in today, but I don't got to re-explain it today if you were here yesterday. If you weren't here yesterday, key person is when there's a key employee that when they pass away, the business loses money, so they buy a policy on them, so the business gets some money out of the insurance policy. This is why you stay for the entire weekend, not just parts of it if you can. All right, let's keep going. Here's another good one. Which of the following insurance policy was a suitable recommendation? Hey, let's go look for keywords, everybody. Rio and Mila are a married couple in their 30s and have children. They recently purchased a house which has a mortgage. Mortgage means term with a 20-year amortization period. So that means I'm going to look for something with a 20-year term, which means in my mind, I already don't like D because D doesn't have a 20-year term. Unless they say something like, but we don't want term insurance. That's why I keep reading. Here we go. They are worried that if either of them dies prematurely, the surviving spouse will have to sell the house, as one's income is not going to be sufficient. They can't afford expensive insurance policies, but wish to keep the house at least until retirement. Which of the following insurance policy would be a suitable recommendation? Well, D's out because they didn't say, but I don't want term insurance. So I know it's either going to be A, B, or C. Now, here's the point I want everyone to notice. I want you to start looking at the differences between the 3 now, and let's compare them. A has a joint last to die. C has a joint first to die. And one says buy an insurance on both. I'm going to take B off the table too, because 2 insurance policies is more expensive than 1 joint one. And they say that they don't have a lot of money for expensive insurance. Everybody okay with that one? Great. Now, in the room, is there anyone that doesn't really understand the first to die, last to die conversation? Because I will explain it. Okay, here we go. A first to die policy is on 2 lives. When one of them dies, it pays out to the second person. A last to die is when they both die, it pays out to someone else. So here's the question I want to ask you. If we're comparing the 2, are they worried about each other or are they worried about somebody else, like their children? Now, someone might say, well, they should be worried about the children. It's A every time. But read the question. Because they say this. If either of them dies, the surviving spouse will have to sell the house. They're worried about each other. They're worried about when one of them die, not when both. So we're going to go with first to die every time in this question. Are we okay? Yeah, and we don't got to worry about 500,000 because they're all 500,000. No math. Everybody okay how we did that one? Good on everybody for putting it in. That's an easy one that we can just like, yeah, give me 38 questions of that in this certification, please and thank you, right? That'd be nice. Let's do this one. What's the maximum that can be converted? VP of a financial institution in Quebec. Oh, Quebec rules are crazy. Just kidding. I'm not ragging on Quebec. I'm just teasing. The only thing that the craziest rule in Quebec is you can't turn on a red light. And I learned that very quickly when I went to Quebec. And for those of you that have been there, you know. All I heard was boo, and I was like, what did I do wrong? And they're like, you can't do that. And I'm like, oh, okay. Plus, they didn't I don't know if they like to speak English, but it's okay. She has life insurance through a group plan, which provided with group insurance is $700,000. She has additional $300,000, giving her a total of $1 million. Yesterday, she handed in her notice. She has decided to start her financial services company. While filling out her paperwork with her HR, she requests that her group life can be converted to individual. What's the maximum she can convert? Now, some of us might say, I don't know. So what should we look up? You tell me, what should we look up? I don't know what it is. What are they asking? What in the answers? Group to individual, conversion, convert. Yeah. Anybody else? There's lots, actually, that we could search. We could look up group coverage, right? Group life insurance. Yeah. I think conversion or converted might be the best way. But remember, if I type in converted, right, I'll only get converted. But if I go back, I'm going to get conversion, converted, conversions, all those things. So there's 119. I got to be a little bit more specific because 119 is a lot. So what if I go group? Well, I get 260. Oh, geez. So how about we go converted? Oh, if I can't spell that, converted. What if we did group converted? No, because there's no group converted together. Group life insurance? How many of us have been through this game where you're searching and there's just a gajillion things every time? Yeah, so we just need to be more specific, more unique. Why don't I put in the word maximum, which doesn't show up in every answer? 73. Coverage maximums. All right. Or I just find the group term insurance coverage in the table of contents. Or Quebec. Thank you, someone that threw in Quebec. So good. Quebec's the most unique thing in that entire question. And if I go through this, conversion privileges in Quebec. Nice. This is where we want to go. It's the most unique thing in the entire question. It's awesome. So here we go. Leaving the plan. Is that what she's doing? Yeah. So we're going to go to 6.6, 6.6.1.1. Let's go. The amount of insurance on participant's life that is eligible conversion must be at least 10,000 and may not exceed 400,000. I guess it's going to be A. We found it. It's awesome. I wouldn't think it wouldn't be in there. So, Lucas, this is one of the reasons why sometimes this gets called the LLQP, the Harmonized Life License Qualification, is because SEG's life, accident, sickness, those are universal Canada across. It's the ethics, which is common law ethics or civil code ethics. That's the part that's different. So these three modules include Quebec. It's the ethics one that has different rules. Yeah. Isn't that awesome? Search Quebec. Find it. But we could have looked for conversion privileges too. Now, let's all have a learning moment. Okay? When I'm in a situation where I'm having a tough time figuring out what to search to teach you guys, I'll tell you what I do. What I start doing is I start going to the section where the answer is, and I start picking out words that are in both sides to find out what words I could have searched to get there. Right? Group, right? Groups in both, but that one's general. And I start figuring out group life insurance is in both. Group life insurance is in both. And I start figuring out what words as I go through these exams that I need to start searching in the exams when I see them. So you start differentiating unique words from non-unique words. So you start to figure out what words. Now, I'm not saying you do this in the actual exam, Usama. I'm saying when you do your chapter quizzes and mocks, and you have to go back and look at that section that you couldn't find, this is how you start to figure out what words matter and what words don't. Especially for those of us that maybe English isn't your first language, this is even better for you because you start to figure out what words you actually need to know in English rather than the ones that maybe you can let go. Right? Because I work with people in my office that speak Spanish and I only pick up every third word, but sometimes I get it and sometimes I don't. Yeah. You can look up 400,000, I guess, too, but that's a pretty rare one to go with. Now, someone might say, well, Eric, what about the 300,000 of this? This doesn't say that it says she has additional coverage, but they're not asking how much coverage she's going to have at the end. They're asking about how much of it can be converted. Right? So we just got to make sure that the answer we're picking answers the question they're asking. Otherwise, we miss what they're asking. Do provincials allow chapter search? Yeah, pretty sure. Everybody okay on this one? We found it, even though it was a little struggle. It's okay. We're good. We'll do two more, and then we're gonna wrap up a little bit. Let's see if I can find a couple of good ones. Here we go. Here's one of those chapter 7 questions we talked about before. What are the tax implications of the loan? What do we say about policy loans? You can loan your ACB out tax-free. Anything above, taxed. Let's go. Nicole has a $500,000 universal life with a $200,000 cash surrender and a $100,000 adjusted cost base. So she can loan up to $100,000 tax-free. She needs $80,000 as a down payment for a new home and decides to take out a loan. What are the tax implications? None, because it's under $100,000, under her own money. So it'd just be, let's see, it says A, Nicole will have to pay tax. No, she won't. B, the ACB would be reduced by 80, but she'll have to pay tax on 20. That's not true. C, Nicole will have to pay tax on 120. Why would she have to pay 120? That's more. And then D says the ACB will be lowered. That's true. So her ACB will go from 100 to 20 because she loaned 80, but no taxes have to get paid. Everybody around now? Yeah. It's like what I explained shows up in the test. I know. Crazy thought. Everyone's just staring at me blankly. All right, let's do this one too. By the way, I take this staring at me blankly as I understand everything you're saying. Please continue. Because that's how I have to treat all the non-video friends. Do you make the exams? No, I don't. I'm just very good at writing multiple choice exams, and I want to impart that on you. Okay? And I don't know if you noticed, I'll tell you what I do. I read the last sentence. If the current amount for children's benefit under CPP is this, how much will Kaylin receive? How much do I know about CPP? Not much. So guess what I should probably do? Search it. Whereas in the other topic, the loan, I reminded myself of what I remember about it, and then I applied it in the question. Don't ever feel bad reminding yourself before you go dive into the paragraph what matters, because then you look for what you need rather than focus on the extras. It's like when I go to the grocery store, I remind myself what I need, so I go find what I want rather than get lost in the produce section. Right? Go find what you need. All right, here we go. Let's look up CPP. Canada Pension Plan, Survivor Benefits. I'm probably going to go there. 10.4.4.1. Let's go. So we're looking children's benefit, right? So I'm going to scroll down to the children's benefit. Child of a deceased CPP contributor can receive a flat monthly benefit of $294.12. If both parents die and their eligibility, the child can receive 2 payments. The child must be under 18 or between the ages of 18 and 25 and full-time student. Let's go back. Jazz Preetner and her spouse Kartik, 65, had a 16-year-old adopted child named Kaylin when they both passed away. Did anything on this side say anything about adopted children? No, so don't worry about that. Sounds like they're treated the same. Both Jaspreet and Kartik were eligible. If the current child is this, how much will they receive? Well, they both passed away, so he gets double, just like it said. So it's not about the math. It's knowing that he gets double. So 294, 12 times 2. 588.24. Everybody okay? See how it wasn't really about the math? It was about the concept behind the math. Don't get lost because there's numbers. He has to be under 18 or between 18 to 25 and a full student. Make sure you read it. Make sure you read it. Mhm. See how everyone was like, oh my God, we're gonna have to do CPP math, and then it's not even about the math? I don't freak out. It's not as bad as it looks. It never is. Clear? All right, one more. There's one more that I wanted to do. Here you go. If Brittany remains disabled for another 2 months, which of the following statements is true? Brittany, full-time physiotherapist, has participating whole life with a waiver premium for total disability. And the several riders, her waiting period for waiver premium is 90 days. So she has to wait 90 days to get her first waiving of her premiums. She has a very serious accident 30 days ago, suffering multiple injuries as a result. If she remains disabled for another 2 months, so 30 plus 2 months is 90 total days, which the following statements is true. Brittany's premiums will be waived. True. That's what waiver premium does. And everything else just seems more complicated. The benefits won't be suspended. They waive the premiums. They paid for you. The premiums will not be waived. It will be because she get 90 days, 30 days, and 60 days more, and the dividends will not be paid. They will be because all the waiver premium does is pay it for you as if you paid it. Everything else works the same. Nothing else changes. Everything stays the same. Are we okay? See how I remind myself of what I know and I stick to what I know? Do that. Does she become healthy after the 2 months? It says if she remains disabled for another 2 months. It doesn't say when she gets healthy. I don't add things that don't exist. I can't assume things they don't tell me, and I go with what they do tell me. All right, I'm going to stay with me. I'm going to pause it while I answer all the other questions, and then we're going to see how we did, and then we're going to wrap up the weekend. And by the way, I will still stick around to answer some questions at the end, but here's a caveat. If you're going to ask me questions about what I should buy for myself as my own personal insurance, I'm not going to answer those. You need to go talk to your field trainer and your SMD about that. And I will tell you that every time because I'm not here to talk to you about what you should buy. I'm here to teach you how to pass a test. Is that okay? Provincials are open book. Yes. Stay with me. I'm just answering all the other questions here. Hold on. Right. So she would have to pay premiums for that 90 days during the waiting period. Yes. And then they would start paying the premiums for her. Yeah. That's why when you're calculating a waiver premium when you're calculating a waiting period for a client, sometimes knowing how long they can wait is a good thing because that's how much the waiting period is. Open textbook, not open notes. You're right. All right, here we go. Submit it. So how many do we do? Did we do the 10? Yeah, we did 10. And we got all 10 right. Some of them we had to search, CPP. Some of them we knew. We're okay. Isn't that crazy? I could do 10 questions legit and answer A on every question and still get a 56. That just shows you need to focus on what you do know rather than focus on what you don't know. Get as many marks in what you do know as you can. And then if you've got to guess on some, it's okay. Just don't guess blind like I did. Everybody okay? All right. Take this down for a second, which I will answer questions. We're almost done. Stay with me. 5 minutes. The weekend is a doozy. It's a lot of information. What I want you to do is I want you to understand that this is the core of what you need to know for this modules. And you need to realize that what we went through today is kind of the basics, the core, the backbone of these topics. You might notice a lot of things we talked about showed up in the test. And you might notice some stuff we didn't go over ended up showing up on the test too. But what did we do with the stuff we didn't talk about? We searched it because we get the open book. I'm not saying you need to know everything, but I'm saying you need to know enough. I've had people that take these classes and take certs and pass, or take provincials and pass. But here's the rub between it. Is it enough to pass? For some of you, yes. But it comes down to a couple different things that we're going to talk about. Just stay with me, okay? There's two sides of writing an exam. One of them I focused on a lot this weekend, and some of it I can't focus on yet. I've talked to you a lot about competence this weekend, learning how to take the test, learning a bunch of stuff about taking the test, about the content. The other side of it is confidence. You need to have enough confidence that with the topics we talked about this weekend, that you can just answer them as if they're right. But if your competence is a 10 out of 10, but you're a 0 out of 10 and you're trusting you know what you're talking about, confidence, you will overthink your way into wrong answers way more often than you should. So you need to have a good enough competence to get answers right, but you need to keep your confidence in what you do know high enough to get them right without messing yourself up. That's the test anxiety conversation. Because yes, you'll get nervous, but you need to do it anyway. And you need to shelf how you feel for a limited amount of time. You can do it. Now, we're almost done. Stay with me. Sometimes people wonder how I can keep excited through doing these classes. How do you keep it going for 9 hours? Because it fuels me when you pass. I want you to pass so bad. Probably more than you understand that I want you to. Now, I just want to know, how was it? And I don't know if there's going to be some kind of survey coming out. There might be. I don't know what's going to happen because it's our first time. But I would love for you to share the good vibes with your hierarchy if it was good, so we can get feedback, good or bad. If you're like, this guy's jokes were awful, don't make that joke again, maybe I'll make an adjustment for you, right? But I can only make the jokes so good before it comes a comedy show rather than doing the information, right? But hey, I appreciate all of you being here. It was awesome to have you all here. And I am going to stick around and answer some questions after. But if you got to go, I hope you have a great weekend. And I'll see some of you, if not earlier. And if you're looking to get my email address to talk to me about something, I'm sure there's a way to get it. You could reply to your confirmation, which probably comes to me. But don't all email me all at once, because that's a lot of people. And I'm only one guy. Okay? But I appreciate everybody being here. Hope you have a good rest of your weekend, and I'll chat with you. Stick around if you want to do some questions. Bye.
Recording stopped.